In today's episode, we're looking at 3 investment mistakes to avoid. We're going to look at real examples from my portfolio, at some mistakes I've made in the past, and how you can avoid them in your financial future. But first, if you want a channel that's going to help you speed up your journey to financial freedom through dividend growth investing, Stately Investing is the place for you. So hit that like button, hit that subscribe button, and turn on notifications. Let's get started. All right, so I wanted to do an episode on 3 investment mistakes to avoid. We wanted to talk about some examples from my past and understand how things have gone wrong, what I could do to correct them, if I've corrected them. And we're going to go in order from the least important mistakes to the most important mistakes and how you can avoid these things yourself. So I really want to get you guys up to speed, and so you don't have to make the same mistakes that I did. So the first mistake is buying the dip too early, right? So this is trying to time the market when you know that things are going down in price. So looking at buying things on sale. You guys know I love to buy things on sale, right? I'll put a link to my video on buying things on sale below and up top. But oftentimes when I see prices drop, I will react and buy the dip, right? That's what we encourage. We always want you to get a good value on your purchases. And so I will often encourage people to buy the dip. However, if you're impatient and do this too early, your stock prices can drop even further, right? And we've seen this actually in the past week. So let's look at an example from my portfolio in this past week where I've bought things too early and the stock price continues to dip. All right, so let's look at my Robinhood account here for the past week. You can see the past 5 days of activity, and you can see that I'm down overall about almost 3%, 2.64%. And you can see what happened here. We're going to look at some of my buys, some of my orders, and see what went wrong, right? So this week, I see things are starting to dip, and this is Monday, and I say, you know what, things are going down, it's time to buy, right? I'm super excited to buy things because everything's on sale. And oh, on Tuesday, it looks like it kind of paid off, right? Things are going back up. Things are kind of peaking, but things are coming back down again. That's not a good sign, right? So I'm down, about 1% or so here. At first it looks like, oh, great, I'm up, right? But now things are coming down. And then Wednesday, things are really starting to drop, right? Things are kind of hitting the bottom of this recent dip here. And actually what I did on Wednesday is I went over to my M1 account, and in my M1 account, I just bought my entire portfolio, right? My entire portfolio was down. I said, hey, this is a great time to buy things. So Thursday, things started to go back up, and Friday, things kind of went up basically for me here. So if we actually go into my account here and look at my history and look at my orders, you can see, right? So let's start at that first day on the 21st. I'm just buying things like crazy, right? I'm buying a bunch of stores at $26.74, and then I'm buying some more store because it dropped another 10 cents, right? And then I'm buying Prudential at $64.16, and Realty Income at $60.06, Bank of America at 24, Altria, right? So I'm just buying things like crazy. And then it's like, well, okay, things are continuing to drop. So let's look at Bank of America. That's a good example, right? So on Monday, I bought things at $24.08. And then on Tuesday, I bought again at $24. And I made that a limit buy. So that way it had to hit a certain price before I would buy it because things continue to drop. So if we go back to my account and see what Bank of America is at now, right? It's at $23.46. So it's actually lower than what I purchased all of my, earlier stocks at earlier in the week. So that just shows you that I bought the dip too early, right? This price, continued to fall throughout the week. I made some purchases earlier in the week thinking, hey, it went down. Now's the time to buy. So again, this is a mistake that people frequently make. They will get a little too eager to buy the dip, and you want to avoid that. You want to be more patient and looking at support levels, right? And this is when some technical investing can help, and or technical analysis can help, and knowing what is that right price point to actually go in and buy, and having that price point in mind before you just purchase things. So again, I think limit orders are the way to kind of enforce this. So you say, hey, this stock is going down, but I'm not going to buy before it hits a certain price. And you can do that in several platforms. I typically use Robinhood to buy my individual purchases. So you can do that in Robinhood, where you will put in a limit order. So why don't we move on to the second mistake to avoid? So the second mistake to avoid is buying companies you don't believe in, right? So this is, you hear great things about a particular stock. This company is giving out great dividends. It has a high yield. You're super excited about its upcoming product line or features, but you don't really understand how the business works, or you aren't all that convinced that you would buy the products or services that that company sells, but you still invest in it anyway because you hear from other folks, Twitter or your friends and family tell you, hey, this is a great stock. You should look into this. You should buy this. Well, the key to this is do your research, right? I can sit on my channel all day and tell you what stocks I buy and what I believe in, but I believe in those things, right? If you don't believe in them, then you will suffer the consequences because you don't really understand their business and how it works, or it's just not something that you agree with, right? It's not something that you think is actually valuable in your portfolio. It might not align perfectly to your strategy, or it might just be a company that you're not super interested in, or you don't have a good feeling about. So let's take a look at some sells of companies that I've done because I didn't really understand the business, and I had to then go sell them when they were down because I didn't have faith in them. So we'll take a look at my M1 account. All right, so we are going to look at some sells here in my M1 account. I'm going to take you through my history here where you can see if there are any sells, and you can see that there are some, and they're mostly at the beginning of my account, right? This is when I didn't necessarily understand some of the companies I was working with, and then after I did a bunch of analysis, I ended up doing sells. So right here's a big one, right, where I sold 12 companies from my initial portfolio. Here's another one where I did 4, but let's look at this one where I sold 12 companies. So these are the companies that I sold here, and then here's what was purchased instead. And most of these companies I still have. I think there's a couple in here that I got out of, mostly because of the sector. But you can see these companies, I didn't really understand them. And there's a common theme to them. They're either energy companies or they're financial companies, right? And these companies all probably have great dividends, right? They were recommended because they're either on the Dividends Aristocrats list or some other list that I looked into and kind of compared and did some initial like basic analysis of, oh, this dividend looks great. They've been growing their dividend over the past few years, and that's all I really cared about. But then after doing some extensive analysis, right, this happened in January. So I probably did my December analysis where I started looking at more factors. So, I look at their revenue, I look at their debt, I kind of look at how those trends are going over time. I look at their kind of earnings per share. I look at more financial metrics and do like some serious financial analysis. And you guys can check out other videos of mine where I do some financial analysis. But this told me that these don't really belong in my portfolio. I don't understand how their business works, or I don't align with that particular sector. I don't really love those sectors. And so I end up selling those stocks in order to buy into those companies where I should have been invested to begin with, right? And so the reason this can be bad is because this typically, if you don't understand something, you don't know when is the right time to buy or sell. And so trying to time this is just not good. You are diverting money away from companies that you actually do believe in. And so I think the idea here is to, again, do your research. Don't rely on what others tell you. Really make sure you understand the business and be patient with your strategy, and make sure everything that you're purchasing, every company that's in your holdings actually aligns to your strategy. So why don't we move on to the third mistake to avoid? So the last and biggest mistake to avoid is starting too late. So starting investing too late. This is a mistake that I've made. This is a mistake that many people have done in their past and wish they would have started earlier. To all of you teenagers and 20-year-olds who are out there investing or watching this channel, I congratulate you because you're smart enough and savvy enough to understand the power of time and compounding, and how if you invest early, then you will reap those benefits later in life. I am 38 years old. I started investing basically with my company's 401k. One of my first big jobs that I had, where my employer was matching my 401k, and that's kind of how I started investing, and that's where I started. Right, that's the way a lot of folks actually get started, I believe, is kind of with their 401k, and understanding that. So that kind of intrigued my interest. I would say this was probably 10 or 11 years ago. So not horribly late, right? I was in my early 20s, but I could have been doing more, right? I could have been investing more. I could have been doing more research on it. I just kind of let my money sit there. I think I contributed the max to my company that would allow me to match, but nothing above that, right? And I did that for several years. And now when I look at that same portfolio, there's that chunk of money, and that's the biggest chunk of my portfolio. You know why? Because it started early, right? And the power of time. And so let's look at some examples from my M1 account, where you can just see where I started and potentially what would have happened if I started even earlier. All right, so we're in my passive income portfolio on M1, and you can see the year view, right? So this is my entire portfolio. You can see the 39 holdings here. I have a dividend yield of about 3.75%, 0% expense ratio. And you can see the returns are based on an initial deposit of $100, right? So my yearly rate here is 5.56%. It's actually, if we actually look at my portfolio, it's a little better, because I've been invested for a little over a year. And so there's some big gains towards the beginning of that. But nonetheless, right, we look at this year. I started this portfolio in early September of 2019. This only goes to late September of 2019, right? But you can see that, let's say this is reasonable, right? A 5.5% return for this year. Now, what would have happened if I started this exact same portfolio 2 years earlier, right? So 3 years, I would have gained 24.4% return, right? And that's, if we divide that by 3, right, that's about an 8% yearly return. Pretty good, right? So, better than this 5.5 that I'm making. And that's mostly probably because I would have done some reinvestments. This would have looked at just the sheer price of the stocks increasing. And then let's look at the 5-year, right? The 5-year, it shows even bigger, right? So 61%, so let's say 12% per year. That's pretty good, right? So I think the idea is, if you start earlier, the more investing you can do earlier, the more your money works for you, right? We want our money to work for us. We're working towards, or at least I'm working towards, financial freedom. If you're watching this channel, right, you know that my goal is really to retire early. I'm hoping to retire around 55, 56, rather than 65 or so. And I have some goals in order to try to achieve that across multiple portfolios. But really, my main strategy is dividend growth investing. And this is my passive income portfolio that does that. So if you have a similar strategy, the earlier you invest, the better. And there's nothing like time, and you can't get that time back, right? So like I said, I encourage you to start early. To all of you folks that are watching out there, if you're young and you're not sure if you should be investing, I would recommend you do some research. Personally, I recommend you get started with ETFs, so some more kind of automated funds, so that you don't have to worry about picking individual stocks so much. But you can watch a video I have. I'll put a link up top and below on ETFs that I recommend. But overall, I would say just get started early, whether you have $10 or $10,000, it doesn't matter. With the platforms we have nowadays, you can really just invest with small amounts of money and get started. And getting started is probably the biggest barrier to a lot of folks out there. So I highly recommend you don't make the same mistake I did and let your money just sit around or spend it on things that you don't need, and start investing early. So why don't we jump back and look at a recap of all 3 mistakes to avoid, just so you can keep them fresh in your mind, and we can make sure that you don't make the same mistakes that I did. All right, so once again, the three mistakes to avoid: buying the dip too early. Be patient, right? This is my main piece of recommendation is be patient. Don't necessarily jump at the first dip that happens with any of your individual stocks or your portfolio. Make sure that you're aware of the price limits that you'd like to set and don't make a purchase until those stocks hit that price limit. So this is a fairly minor mistake, but something that I do often and that I'm trying to correct and I'm working on to get better at in the future. Second is don't buy companies you don't believe in. So this is a big piece of advice. It will save you kind of heartache in the long run and having to sell companies that you don't really believe in later because you either A, don't understand their business model, or B, you don't really believe in them and you're just kind of taking the advice of others. Make sure you're doing your research. Try to do as much financial and business analysis on the companies that you're looking at before making the decision to purchase them. And then lastly, and most importantly, starting too late. Don't make the mistake of starting too late. Start today if you haven't started investing. There are ways to get involved in small amounts if you are wanting to avoid a bunch of risk and putting in a large amount of money, or if you know what you're doing and you're ready to go all in with some money you've saved up. I highly recommend you do it. So these are the three mistakes that I would want you to avoid out there. I hope you guys got something out of this video. If you did, hit the like button, hit that subscribe button, turn on notifications. Also, leave me a comment on any other mistakes that you've made throughout your investing journey and you want others to learn from. I appreciate all the comments and the feedback. I hope you guys have a great week out there, and I'll see you guys again in the next episode.